Live streaming is on.
All right. Good afternoon, everybody. This is Event Trader coming to you with Brandon Mars, options trader. You know him better as on the site, and he's been doing a great job for us here, really posting some fantastic trades and just kind of expanding some of the tools that our subs can use in terms of trading. So I am going to welcome in Brandon right now, and we're going to start up our discussion. So, Brandon, how are you doing today?
I'm great. How are you, Gavin?
Doing pretty good, doing pretty good. Just making sure that we're running live here. Looks like everything is off and going. Again, if people are having issues, just try to refresh your browser, and that should take care of anything like that. So, all right. Well, Brandon, just taking a look. Hold on, give me one quick second. I got a live window somewhere here. There it is. Oh, okay. So, Brandon, yeah, let's take a broad look at the markets here. I'd be curious to get your thoughts on what's going on. Obviously, we got that debt ceiling talk after hours and CPI tomorrow, so feels like a lot of people sitting on their hands ahead of that. So, what's your general take on the broader market right here?
Yeah, so I'm mainly a chart watcher. I obviously pay attention to those headlines you just mentioned because those are obviously important for the overall direction. But as a chart watcher, I mentioned this in my morning notes the other day. I mean, I could probably make some arguments on the S&P and the Dow that they've got a few recent resistant levels to get through. But if I look at a chart like the Nasdaq, I mean, that thing's just kind of sitting there coiling. It really looks like it wants to break out to me. I mean, obviously we have some potential landmines with a lot of inflation data this week, and then obviously those headlines you just mentioned. But the charts look pretty good. A lot of these dips keep getting bought up, so I'm feeling, fairly bullish despite all the stuff that's going on out there. And for me, just as a chart watcher, I learned the hard way during COVID that it really just comes down to the charts. I mean, we had the world that was shutting down, and I had a buddy who was like, "Oh, you got to buy puts. You got to buy puts. The world's shutting down." And the guy I learned charts and options from was like, the chart says buy. You got to buy calls, and he killed it. And my buddy went into the poorhouse. So I've kind of always stuck by that mantra through the years. So if we can push a little bit higher, but even right now, watching the markets tick up, and Dow's kind of picking up here, and Nasdaq's looking strong, and we probably got a few more shorts trapped today. So I kind of like what we're seeing.
Yeah, it definitely the resiliency in the Bears or in the Bulls has been pretty impressive, I'd say, because they've had just about every headline thrown at them, and we're still just kind of sticking around above the 4,100 level in the S&P, above 13,000 in the Nasdaq side. I definitely agree with you. I get the feeling where you could suck a bunch of people in, Brandon, is if that ceiling, if that fails to you see any progress, which I think is, I do think that that's the baseline scenario, but could lead to some further short sellers coming in, and then CPI tomorrow. If we kind of get a nice mix of a high CPI and debt ceiling, and the market goes down and say 41.10, and everyone's throwing their hands up in the air saying this is it, that could certainly be the thing that sets off a pretty big squeeze, in my opinion.
Yeah, no, absolutely. And then, just kind of like on an individual basis, got Microsoft here in front of me, Apple, you've got NVIDIA. I mean, you've got some fairly clean looking charts out there in the tech world. And, we have some of those headlines behind us. I mean, NVIDIA hasn't reported quite yet, but you got the majority of the big tech earnings that are behind us. And there's a lot of charts that look very clean. And, Microsoft and Apple, if, they go up, they're obviously going to lift the market because there's such a heavy weighting. So, I see things like that. And I've talked about this a little bit in my morning notes. This has a potential environment for an area for me to basically not overthink and basically kick myself at night is, yeah, I've had times in the past where we've had similar market scenarios, and I've looked back at the week and been like, why didn't I just buy, calls whenever Microsoft or Apple or NVIDIA dipped? Why did I jump around to a bunch of different names? And I'm kind of starting to feel like that's the environment. And, again, you can't just go and blindly buy calls on these because timing's important, but those charts look clean. And, sometimes it's almost like, why bother going run a screen on 150 charts? Just stick to what's working and, manage your positions.
Well, I guess that if I was to say one thing that I got an issue with the bull side of things is probably how it's really been. I was seeing something. 86% of the gains are in 28 names in the S&P this year. So I mean, the breadth is the one thing I would say, but it's really got to kind of feel. If you remember the Nifty 50 back in the 70s, how they traded, it kind of feels like that. So I'm curious with what you're talking about in terms of looking at the charts. Are you trying to concentrate on the big winners in the market so you're not looking at too much additional noise? Is that kind of how you set up your trading thing, just having 30 names that you're going to trade well?
Yeah, I still look at the noise just because I want to see what's going on out there. And yeah, you will pick up on some of those observations, like you just mentioned, of like, all of a sudden you notice that there's 5 names that are really lifting the market. That's maybe something to keep in the back of your mind as far as a potential flag. I think you're pretty spot on there. But I think at the end of the day, when I try to narrow it down, maybe looking at the noise and then throwing the noise away and focusing on, what looks good out there. Again, things like Apple, Nvidia, Microsoft, probably Meta in a little bit after a little bit of a pullback. Again, figuring out and knowing what's out there, but then drilling down and just kind of being laser focused on a few ideas.
All right. Let's take a look at some of the few ideas that you've been trading as of late. And just we will be watching the markets here. Uh, just kind of floating just below the 4140 area here in the S&P. I would note one piece of news that just came out within the last 30 minutes anyway, was a really strong 3-year bond auction, which is pretty impressive considering all the debt ceiling concerns that are supposedly out there. We just had a pretty solid auction on that front. So kind of keep that in the back of your mind too. I think most people, Brandon, I think you would agree with this, look at the debt ceiling more as a 1-2 day event, and hopefully we can get it done and out of the way. But looking at some of Brandon's recent trades, Microsoft, that's been one of the names you were just talking about the chart. So where do you stand with that right now?
Yes, I mean, Microsoft's probably one of my favorites. This kind of has a post-earnings setup that I really like. If you look back, I don't know, a week and a half or so, whatever it was, you got that real nice move up, little sideways consolidation, and then you had the ignition candle on Friday. Nice big bullish candle to break out of consolidation. We got a couple of inside days that are lining up right now. I got into this one a little bit too early today, but it had a couple flag patterns intraday, and it kind of formed this big giant wedge basically from this morning to a little bit after the lunch hour. So from a technical perspective, when you see something like that, and we talk about these dips being bought, if it can break that, it's made a nice move. I think this thing's got some strength. I was maybe a little bit early on that one, unfortunately, just from a option standpoint, but seems like it should have momentum going forward. We'll see if maybe Google comes out tomorrow during their event and says they have some new AI tool that will kill Bing or something, but I'm not really counting on that. So
Yeah, there's a couple of AI events this week too, so that'll be one thing. It's not just Google. I want to say somebody else had an AI event tonight too. Can't remember who it. I think it might have been Meta Platforms actually. So, but you're not too worried about that impacting your trade here, right?
no, I mean, if anything, unless they came out with something like a true Bing killer, which I don't think they have in their back pocket. I'd almost probably be interested if the market makers used any sort of headline to bring it down. So it is a risk when it comes to options because I've talked about this before. I mean, even a minute to 5 minutes on your options trade can seriously affect your P&L. So if you do get that headline that drops something down, it can be a little painful, but overall, I don't see the strength in Microsoft going away.
Yeah, I'd agree with that. That it's funny to see how much of a safe haven these names have turned into over the last couple of months, well, last couple of years, really, I suppose. But when you got their balance sheets, I guess it makes sense, right? More so than some of the banks and stuff. That's for sure.
Yeah, exactly.
Let's roll over to Roku then. So you're holding the 57 calls. You got into them around 96 cents. So you'd expanded upon Roku in your morning note today. So yeah, you want to talk a little bit about those Roku calls?
Yeah, so that had a morning star pattern. We talked a little bit about the earnings a week and a half, 2 weeks ago, whatever it was. I mean, it wasn't the greatest report, but it had some positives and really just continued to fall after that. And then finally had that morning star pattern. Had a nice little trade on it yesterday. Rolled up to the 57 options to lock in some profits. The move off the pattern wasn't exactly as strong as I would like to see, but it was green yesterday. Was an outperformer, and did kind of grind a little bit higher and make a higher high and a higher low from Friday. So I stuck with it. I mean, it should have some more upside. I would think it would test the 100-day and potentially the 20-day, but it's been a little bit of a laggard today. I mean, I kind of got a reminder that Roku's a lot of fun to trade at times, and it's just a complete pain. I mean,
It's a whippy one, that's for sure.
yeah, every stock, I could probably say that at some point about every stock, but just there's a few that stick out, and Roku is one of them where I said to myself yesterday at one point before it started moving, I'm like, why did I pick this one on a Monday morning? But it ended up being I think it ended up being like a 50% trade or so, and then there was a little bit more upside on the roll, but ended up just kind of holding on to those. But as long as the market keeps going higher, I think this is probably a little bit of a digestion day, and hopefully it will kind of push higher to the 57, 58 level later this week.
Yeah, it looks like it could come in on the doji scans for the TA page scans potentially, but 121 million floating at 10% short interest with an ATR nearly at 3, which is basically about a 6% move on a daily basis. As you're saying, Brandon, this thing can be a whippy trader, that's for sure.
Yeah, I mean that's really one, and no guarantees by any means. I'm not saying this is going to happen, but I mean that's one that you could just wake up tomorrow morning and it's up 7% in the pre-market and it's just soaring. So again, it's whippy, so a lot of fun when it's whipping the right way, and a little annoying when it's whipping the wrong way.
Yeah, that's it. When you're saying it's a fun one to trade, I was gonna say it depends on which side of the trade you're on, I suppose.
Exactly.
So we'll continue to hopefully be on the right side. But one play that you took some action in today, and that's Salesforce.com CRM. You have the 200 calls around 127. Now you had a follow-up comment with it at 9:55 about a roll into the 202.50 strike. So I know that there's been a few feedbacks about this for anyone. Brandon, I believe you posted an in-depth comment on option rolls a couple of weeks ago. So we'll go through and we'll try to find that. And what we'll do is we'll tag the learn to it. My recommendation for anybody that's new to the options trading and is unsure what Brandon means when he's talking about rolls, you just park that comment. You can do that by clicking on that blue P button in the side of the comment. But am I wrong in that you did post a rather in-depth color on option rolls, didn't you, Brandon?
Yeah, and we've actually talked about it on audio as well. So there was a little segment on that. So again, it was Audio X. There are two presentations. I could go back through and find exactly when we discussed that to just kind of point people directly to it. But yeah, we've talked about it a couple times now in the room and on audio. So we'll definitely push that out to everybody. But yeah, as far as the CRM trade goes, so started out in the 200 calls, went up to the 202.5, and actually now into the 205 calls. So for me, this is just kind of a textbook trade breakout in rolling of options. If you look at the chart on a daily basis, this has had a pretty nice ascending triangle that's formed for a few weeks. Tested the 200 level, and today, I don't want to jinx myself here, but today's looking like the true breakout of that 200 level and the break of the triangle. So, again, for me, I entered into the 200 options, and in hindsight, I probably should have just even started out in the 202.5 or the 205s, but I kept it a little bit conservative because CRM, I didn't trade it so much before it went into the Dow, but ever since then, it sometimes can have a little bit of a funky trading pattern as far as a tech stock goes. So I kept it a little conservative, went with the 200. And it's just moved very well today. For the most part, it's got a pretty defined uptrend throughout the day. And throughout the day, each option has entered into the money and become fairly profitable. So again, for me, the reason that I lock in and roll is to lock in gains and to reduce my risk in the trade. I don't love to sit on huge amounts of profits when it comes to options. You talk about the debt ceiling today. You all of a sudden could have, McCarthy come out and text and say, we're not going to negotiate with the Democrats whatsoever. We're going to let the country default. I don't think that's going to happen, but
he did come out saying that he didn't want to push the debt ceiling out to September 30th. So you're not out of line on that, I would say. I mean, I doubt he's going to say we're going to default, of course, but yeah, but there is that headline risk out there for sure, and especially when you got a pattern like this, where I mean, it looks like a great breakout pattern. Just looking at it, it's going above the 200 psych, obviously, which also happens to line up with that 200 weekly moving average as well as the 20-day moving average on the chart. So I would agree with you. There is a risk of this being a pretty nasty reversal pattern if you get the wrong headlines.
Yeah, I mean, again, we've got some longs that have piled in. People have been buying the dips. So if that moves against you, it can move quickly. And I like to lock in those profits. And another reason that you roll is as an option becomes further in the money, the more it's going to trade at strictly its intrinsic value. So, I didn't start in the 195s, but for example, the 195s, the premiums right now are about $8. So the stock's trading at 202.68. So you've basically got about 30 cents of premium there. So at this point, that is essentially trading as the stock. Now, there's absolutely nothing wrong with that. There's a strategy behind that. But when you're playing a breakout, you're going to have some more upside if you kick, your option further out of the money. So just for perspective, and the numbers that I'm about to give, these are strictly off of if you were to basically buy this option right at the close. So, the numbers would be a little bit different as far as rolling and intraday numbers, but just perspective. If you bought the 200 strike at yesterday's close, it's up 132% today. The 202.5 is up 156%, and the 205 is up 183%. So again, I've given the warnings that don't just go and buy way out of the money calls because you think, you're going to get rich. But when you have a breakout trade in a high sustained move like we're seeing today, the further out of the money, generally speaking, there's a little bit more to that, but the further out of the money that you go, the higher the profit is going to be. And again, it will eventually hit an equilibrium where you're just, like the 225.5s are up 33% because it hasn't moved that much. But if you start to hit that sweet spot, so basically when I get an option that's approaching in the money, I will lock in that profit, reduce my risk on the trade, and I will roll up in anticipation of a further breakout. And again, if I don't think that there's any more upside, then I won't roll it and I might exit the position completely. So in a case like CRM, I don't want to sit on the 200s. That's just a personal opinion for me. You are, at points you've been $3 in the money. Basically, your premiums are going to start getting smaller because you're further and further in the money. And for me, if it reaches that point, and I think we're going to reach the 203, maybe 205 level, I'm going to lock in those gains. I'm going to reduce the amount of capital I have in the trade, and you're going to see further upside if that stock continues to move higher. And for me, eventually, if you roll up enough, I mean, at 2 roll-ups, you get to the point where you're just playing with profits. And the guy that I learned from, he made it very clear that he really basically juiced his portfolio at trades like this. And he would, at points, he would start a week back when Amazon was, trading at 2000 or whatever. There would be weeks when that would make a huge move. He'd start out in the 1850 strike and he'd end up in the 2000s. And eventually you get to a point where you're just so profitable. He stopped watching the trade. He just said, these are your runners. You've made your money. Just let it go and squeeze it as high as it possibly can. And then you close out at the end of the week. So again, this is just a personal preference. I don't want to be sitting on, 150% of gains in the market. It's just not something I want to do. And if I can potentially make even further profit by locking in gains and moving my strike up, I'm going to take that every single time. And, again, it's part of a personal thing, but that's just how I trade.
It's basically a trim and trail type approach.
Yeah. And that's actually another thing that you can do too. I mean, if you wanted to, if you were in the 200s at the beginning of the day, let's say you started with, just 10 contracts, if you sold 2 of them and you rolled up 8 of them, and then at the next time, maybe you sell 1 or 2 and you roll up, I mean, you can all of a sudden be sitting on, your initial capitals back in your account, and you could be sitting on 100 to 200% in gains. And then all of a sudden you end up with like 5 contracts, let's call it, that are just pure profit. And that's where I think a lot of options traders will put their foot on the gas. I am playing with house money. If CRM all of a sudden crashes because of the debt tonight, well, I'd rather not lose on those 5 contracts, but I don't really care at this point. I've made my money. I've taken my risk off of the trade. And on the flip side, if we get any positive news on the debt ceiling tonight, this thing could potentially hit 205 plus tomorrow. And those contracts are going to be very valuable. And I basically entered into the night with no risk. So once you trim and trail and you get a trade like this, it gives you a lot of flexibility on how you want to manage that trade. And that's just one of the ways that I do it. I probably would have said trim a little bit on this one, but it has a pretty nice little triangle. It's looking pretty strong today. I mean, this is kind of a breakout I've been watching for a while. So, for me, I wanted to kind of leave a little bit more on the table on this particular trade.
All right. No, that's all good information. So I do see that we've got a number of questions. We'll circle back around to them at the end of the discussion here, but we're going to move on and talk. So basically, Brandon and I are going to continue to evolve this piece here. Right now, we're just kind of leaving it at we're going to discuss broader markets, some of Brandon's options trades that he's got going on, and then try to talk about some different topics and subjects in options trading, just to kind of help educate some of the people that might be new to using this instrument. So today's discussion, we're going to take a look at covered calls and some of the reasons why you might want to use it. I know there's definitely a lot of people that have positions out there, but they have that wall of worry in the markets that they're concerned about and want to protect against the downside. So this is going to be a good way to do it. So going forth with it, Brandon, covered call. Why don't you explain to the subs exactly what you're doing with the covered call there?
Yeah, so I think I had mentioned this before. I actually have not done a covered call in quite some time. Used to do them a little bit more in the past when I used to hold bigger stock positions, but now I'm just kind of as a day trader, I don't touch them quite as much. But as we talked about, we're entering into a period of potential volatility, or we've been in one. So this is a potential environment where if you are nervous about the markets, that you could use a covered call to, really use it as a short-term hedge to protect your position from any sort of market downturn, and also as a way to generate some income. So, the basics of a covered call is one call equals 100 shares. So if you own 100 shares of a stock, you could go out and you could write one call on that to basically protect your position if you thought that, it was either going to go down or if it was going to, move sideways. So, if you look at like an Apple, I think last night, this has probably changed today, but I think the 175 call was trading around $1. So, if you owned 100 shares of Apple, you could go out and you could write one contract on that, which would give you $100 premium credit in your account. So again,
Do you like doing a complete cover, Brandon, or do you worry about that as much? Like if you've got a fairly big position and you're just looking to, cover a portion of it, will you do less on the options, or do you always feel the need to do a complete full 100% cover?
I think that's probably depends on kind of how bearish you are. For me, if I was doing it, I usually did it as a full position, just because I kind of was like, you know what, if I think it's going down, like, why not squeeze as much premium out of it on my option? So I always did a full position. But again, if you have a big position, you have that total flexibility. But I always just did it because I felt like I was like, if I'm entering the order, I might as well go full steam on it.
Right, right. And thus you get the full cover. And we are going to have a real world example too for this, where we're going to be talking about Caterpillar. I own it. Brandon, I know you've been talking about the descending triangle in it. So this will be a perfect real life example where I love the thematic um, uh, behind it, the reason for owning it with agriculture. But, I don't want to lose money going on. So we are going to be using Caterpillar in the backdrop for this. But so, Brandon, you like having a full cover on it. Now, basically, all you're doing on a covered call is shorting the calls, correct?
Correct. So you become the option writer. So, again, just your basics. If you're buying a call, then you're bullish, and if you write the call, then you're on the other side of it, and you're bearish. And in this particular case, there's people that specifically just write options all the time, but in this case, you're also just, maybe you're bearish, or you're just protecting yourself.
Now, so one of the things that I'm always concerned about is just the unlimited loss potential of shorting. Now, obviously, it's not a naked short, so you don't have that there. But what would be the difference between a covered call versus, say, a synthetic call where you're just buying a put in the stock?
Yeah, so one would be a net debit versus a net credit. So if you write the call, then you're going to see, that $100 premium is going to enter into your account. And if you go in and buy the put, then that's going to be taken out of your account. So, I guess it kind of depends on whether you want to make a little bit of money into your account as far as your positioning goes. And then, in theory, if you were to have the synthetic on there, your upside potential would, in theory, be higher, because if the stock continues to soar, you would get that upside, where in theory, if you have the covered call in place, it would kind of cap those stock gains. And, that makes me think of something. I mean, if you do a covered call, you have to mentally be prepared that you are, in theory, rooting against your stock. Obviously hedges, that's what they're there for, to protect yourself. And they're not always there to necessarily, make huge amounts of money. But I remember the first time I wrote a covered call, and the call started doing well when the stock price started going down. And I was kind of like, well, I don't want my stock to go down. So you got to kind of keep that in the back of your mind mentally, that in theory, for your call to be working out, you are rooting against the stock that you own.
Yeah, and always mixed emotions there. Now, so I guess there's a couple of things that factor in on that, because really what you're looking at, and I would assume this would be the most important aspect of a covered call, is you're trying to time a lull in your stock, and then continue holding it with the expectations of it breaking out. So really what you're trying to do in a covered call is guess that exact time that you're going to get that little dip in the shares that you have. So how do you factor that in? Is that the most important aspect of this trade, do you find, Brandon, or what?
Yeah, you definitely want to be at a time where you're looking at a dip. I mean, as the market right now, like CRM's probably a pretty good example as it pushes to the highs of the day. Today would not be a day that I would want to write a call on CRM, just personally. I'm sure there's some strategy out there where you might want to, but you would basically be underwater in that, and you'd be adjusting, and that would end up costing you some money. So yeah, I mean, you're really looking for, when the stock is either going to dip or, if it's going to be sideways. Also, if you do it, and, we can touch upon this a little bit further in the Caterpillar example, it also depends on how far in or out of the money that you go. Obviously, if you're writing this call right at the money, you all of a sudden have a pretty good probability that that could move against you. If you write the call and you're, I don't know, 1, 2, 5 strikes away from the money, then you've got a little bit more of a chance that that is going to work out in your favor. So I think it's definitely the price target, and then also the timing as well.
And well, also just in terms of what option you want to buy, right? I mean, usually when you're trading, you're just going out on the weeklies, but do you find that you have longer time horizons when you're doing this? Because I mean, it's basically an income trade, right? Where you're just kind of trying to generate income while your stock's lagging.
Yes, exactly. Way to generate income, and as it's a hedge, and it's an income play. Absolutely.
So the timing when you're doing something like this, Brandon, do you find yourself going out a little bit further than you usually do?
For me, I think I'm just so accustomed to the weeklies that not necessarily. I mean, maybe on something like a Caterpillar, just because the blue chips sometimes don't trade as many options as, like, a Meta or a Tesla. So you might find more attractive opportunities, on the monthlies. Yeah, and I mean, again, I think that kind of comes down to, what are your thoughts? Like, are your thoughts today that the debt ceiling is just gonna be an absolute fiasco after the market? And, are we gonna wake up tomorrow and we're gonna see the futures down 3%? Well, if you did that, if you thought that, you know, you could adjust accordingly. If you're thinking more along the lines of, we've had a really nice run, and, we've seen this song and dance before over the last year where we get this nice bounce, and I think that we're going to have a prolonged, month-long period of, a downturn, then you can adjust accordingly. So again, it really kind of depends on, what your thoughts are as far as, where the market's going, what the stock's doing. One thing I would maybe caution is, if you are going further out, a month or so, just know what your events are out there. Are there any sort of company announcements, earnings, inflation reports, whatever it might be? Because
Does dividend factor in largely to that?
the dividend can factor into that as well. Yes, that's a very good point. So yeah, there's nothing worse than going and doing an option and being blindsided by a catalyst that was sitting there right in front of you the whole time. So if you do, kick the can down the road, 3 weeks out or whatever, definitely be aware of what's going on out there. And again, just like any trading, if you go 3 weeks down the road, I mean, there's a lot of different headlines that we could get out these days. So that definitely comes into play of, how potentially bearish or bullish you might be on your stock and the market overall.
All right, just keeping an eye, getting an alert for everybody out there, just in case you're paying attention. AI coming up to test at 20 level here. So let's keep an eye out, as Brandon was mentioning earlier, is Meta Platforms and Alphabet both have their AI events going on. So we'll keep an eye out on that stock as it edges higher here intraday. Just quick circle back to the broader markets. We're still we're climbing above that 4140 at the moment, Brandon. Looks like afternoon highs. People must like the cut of your jib and are buying the broader market here. So we'll continue to monitor that while we're talking with Brandon. Okay, so for the cover, back to the covered calls, then, we're talking about Caterpillar. So, looking at that as a real world example, Brandon, how do you treat in terms of what strike prices you want to get in on a covered call? You had mentioned that at the money could be pretty difficult at times for this strategy. So what is it that you're looking at in terms of your what strike prices you want to go for?
Yeah, so if you're looking at Caterpillar, so Caterpillar's got a little bit of a descending triangle that's formed on it. It has not broken the formation yet, so it might not, but it is setting up that way. And if you were to look at that and say, hey, if this thing's going to break, how do I want to protect myself? So as far as the at the money goes, you got to kind of, I guess, also ask yourself, do I still want this stock? If I wake up on a Saturday morning and my Caterpillar stock has been called away on me, am I going to be okay with that? Am I going to be, am I going to be mad all weekend long? So, if you write the at the money, so in this case, it'd be the 215 strike. And, let's say you did this Friday or a few weeks out, that's where you would make more money than the out of the money. So, again, it's kind of asking yourself a comfort level of, am I okay adjusting this position if it moves against me? Am I okay if my shares get called? For me, if I wanted to keep Caterpillar as a long-term play, I might maybe meet in the middle, and I would need to just double check. I looked at this last night, but again, some of these blue chips can get a little spotty. I would ask myself, all right, we're trading at 214. I've got my 200-day at 217. I've got my 20-day at 218, spot 86. So for me, if I said to myself, all right, I really like my Caterpillar shares, I don't want to lose them. I'd rather just write the one contract and just hope that it either goes sideways or expires. Like, I don't want to have to adjust and, pay more money to rebuy the call. I might consider the 220 in a case like that. And if you look out to the monthlies on the 19th, the 556 strike on the 220 calls has the most volume by almost 3 times the volume. You could pick up, call it a $160 per contract. So if you wrote one contract, you get $160. And for me, if I didn't really want to adjust that position or have to potentially rebuy it at an unfavorable price, I want to keep my shares. I've got 2 layers of potential resistance for that stock to move through. You've got 2, fairly major moving averages that should provide resistance to that stock. And I mean, again, China could announce something on metals tomorrow and the thing could jump up to 230. And that's a risk with any investing. But for me there, I'm kind of looking at that. And you've also got this kind of cluster of candles here that are, over the last week and a half or so that would probably provide some fairly decent resistance. You've got a couple of major moving averages. The 220 there seems like a fairly safe bet. And then if you follow the crowd, you look at the 220 strike on the monthlies, that's where the volume is. So again, from a liquidity standpoint, I like that. If I was, feeling a little
Is
bit
liquidity
more,
a big factor for you on this just because you're shorting?
I mean, yeah, I always try to pay attention to
You want to be able to get out, I'm assuming, if this thing goes against you, just because of the unlimited damage that can be done on the option side, right?
Yeah, exactly. I mean, this has 556 contracts traded today. I mean, that's plenty of liquidity for me. Where I start to really, I've been doing this for a while, so I have a comfort level with it. But, you start finding some of these contracts where, some of the Procter and Gamble and Pepsi, some of the like staples, you'll find contracts that, they trade 15 a day. If I'm writing a covered call on that, I'm probably going to pass on something like that. Yeah, definitely having liquidity, like 556 contracts traded so far today. I'm feeling pretty comfortable there, but you definitely want to make sure that you can exit it. And especially too, if you're writing these on contracts that are thinly traded, a smart market maker, if you don't do that right, they're going to smoke you on that trade, and they're going to figure out a way to get that off of you. So in this, you got a nice, pretty tight spread of 8 cents on your bid ask. So there's some comfort there, and then if I wanted to maybe be a little bit more risk on, the 217.5 strike, 175 contracts, I'm going to get a little bit like $100 more on the premium because I'm taking on additional risks. So I might consider that one, but the 220 probably be safe. And then if you really think this thing's going to break the triangle and it's going to go, you can do the at the money if that's truly what you think is going to happen. And for me, if it started to break that formation, I'd probably be a little bit more inclined to do the 215, 217.5.
All right. Let's see. So just taking a look at this, does it factor into you? I know one of the things that I've always seen on covered calls is that you kind of want to do that in an upward trending market. Do you adhere to that at all, or? Because I guess one of the things that if we're looking at this as a hedging philosophy, and I would think that it would be something that would be more incorporated in a downward trending market, where the upward trending market, I would think that it could get away from you a little bit if you're writing the calls, and all of a sudden we get that blow off in the market. And the stock, obviously you own that, so you're not getting killed, but you're taking a pretty good lumping on that strategy there. So what's your take in terms of using covered calls in an upward or downward trending market?
I would want to only do it in a downward market, just because, again, if you're writing the call and it's going up, then they're either going to take your shares, which again, if you're okay with that, as a way to exit the position, then you'd want to do that. But other than that, that call is going to move against you. So you're either going to get your shares taken, or you're going to have to buy back that call at an unfavorable price. So I would only do it if I thought the market was going down or sideways. We talk about on Friday afternoons the choppiness and stocks getting pinned. Well, there's a couple other factors that go into this, but the reason that market makers pin these stocks is they're working off the option premium. That's why they do those things, and that's why we have those choppy periods. So if you see a sideways or a downward market, for me, I wouldn't write one in an
Hello?
Market unless I was.
I'm just trying to get Brandon back on here. Brandon, you there?
Can you hear me, Kevin?
Yeah. Sorry, you're just cutting in and out a little there.
Okay, sorry about that.
Yeah, I don't know if that was your side or my side, but.
So yeah, just to repeat, I would only want to do options in a downward or a sideways market.
All right, so that's all fantastic information. Now, Brandon, anything else on covered calls that you wanted to mention at this juncture?
No, I think that's mainly it. One thing that you and I talked about, just again for a risk perspective here, the covered call versus a naked call.
Yeah, that's one of the feedback questions too. So good for you to address this.
Okay, perfect. So I don't touch naked calls. They are a risky strategy. I understand where you would maybe fit them in and why you would do them. I gave this example when I first started with you guys in my presentation. I one time stupidly, as a young trader, wrote a naked call on overstock.com, a very volatile stock. And it's kind of scary when those move against you. There's a lot of risk involved, and you can lose your shirt if you do not manage that properly. Again, there are people that specifically do naked calls. It's not for me. There's a lot of risk, and I would be very, very clear if you do any strategy like that of how writing a call works and what your risk is, and make sure that you have money in your account in order to potentially buy stock if you need to. That move for me on Overstock, it was like a 25% move in one day, and I was sweating that night. I somehow got lucky, and the stock then plummeted 30% the next day, and I got away with it. But it was a very big, ugly potential loss for me. And I would just know your risk and know how they operate.
All right. I completely agree on that. That is, given the leverage that you have there, you better be either 100% sure or have some deep pockets if you're jumping in on that side of things, right?
Yes, absolutely.
Okay, so a few feedback questions here, Brandon. I'm going to start throwing these at you. One was, so he just addressed that with the directional bias. Unless it's a covered call, you're not shorting these options, right? Uh, Another question was stop loss point on options. How do you manage that, Brandon?
Yeah, so that's I feel like that's the $1 million question in options.
So it's not how much you make, it's how much you lose, right?
It really is. And I still, to this day, I think managing my losses on options is probably the thing that I struggle with the most. And I'll be very, very honest with you. It is still a struggle because, these things move so quickly in one direction or the other, and they circle around, that you kind of can get this mentality of, oh, it's going to come back. It's going to come back. So, for me, I have personally just found that to be most disciplined. And again, I think you need to formulate your own strategy on this. But for me, it's more of this is a percent that I'm getting out. I'm going to cut and run. So, some people will use the different points on the charts. I have personally just found that a little tricky, where you all of a sudden start working in the moving averages, and then you kind of start telling yourself, well, maybe it's the head fake through the moving average, or, I think it's going to bounce right at that 20-day, and then it kind of doesn't. And, the way that the options pricing works, depending on the volatility and what's going on, you could do this if you crunched the options numbers, but you kind of get in the middle of your day and you're not necessarily doing that. But you never really know for sure how much that option is going to be up or down when it starts to hit those specific points. Again, there's different options Greeks that you can make some calculated guesses, but at the end of the day, volatility could pick up. There could be an announcement, whatever it might be. Those factors are gonna change that around. So I just kind of felt that playing the charts started getting a little tricky for me. For me, I think it was more just, hey, if we reach this point, just get out of it and, kind of put the chart aside for a minute, take a deep breath. One key thing that I learned is you can always re-enter into an options position. So there's no reason to necessarily ride the thing down to 100% loss. And, if you see some of my recommendations in the room, that happens to me. I've gotten caught in positions. I've had catalysts that I thought were going to make the thing recover. And frankly, it hasn't. But I will say, as a new options trader, I would have afternoons where there'd be 20 contracts worth nothing on a Friday, and you learn pretty quickly that you need to get a little bit more disciplined than that.
Yeah, no, I could imagine. So, all right, a couple more questions coming your way here, Brandon. Somebody's asking, what do you consider tight enough to trade spread?
So for me, having done this for a little while, I have a little bit more of a comfort level with a wider spread. Like if some of the recommendations I've thrown out, like MasterCard or Adobe, those will sometimes reach like 50 cents. MasterCard was my number one P&L stock last year for options. So I'll take a 50-cent spread. It's a funny trader sometimes, but it can be a really, really fun one, especially on a Friday. So I'm comfortable with that. I think once you start reaching a buck on some of these, unless it's like unless it's a really, really highly priced stock, once you reach a buck, I kind of start questioning. And then at the same time, I think when you start to reach those points, you also need to start looking at your volume levels, because a lot of the times they coincide. I mean, MasterCard is not a hugely traded option chain. Sometimes we'll have 3, 4, 5,000 contracts a day. So you'll have those 50-cent spreads. I'm fine with them. But I think when you start getting larger, you need to also make sure you're checking your volume. Because I'm okay with a wider spread if I'm going to be able to find some volume on them. Like AutoZone is an example I gave during a past presentation. You've got spreads of like $5 to $10, and you've got like 3 contracts traded a day. I'm going to look elsewhere personally, even though that's been a phenomenal stock. So yeah, usually 50 cents I'm pretty comfortable with. And then anything north of that, I kind of start wondering, is the volume there? Am I going to be able to get out, and am I going to get smoked? And I will say, definitely on those, I mean, I always recommend limit orders, but use limit orders on those. As a new trader, I did a trade on UNH, another one I used to love to trade, and the market makers just smoked me on it because it's so thinly traded in a wide bid ask.
Okay. Let's see. Somebody's asking, do you use the Greeks at all, Brandon?
I do use the Greeks, not, honestly, not as much as most options traders do. I mean, for me, if you look at some of the trades that I am in, they can tend to be pretty short and sweet. So, if I'm looking at a CRM, talking about the trade today, I saw a breakout in that thing. It had a nice ascending triangle, and I thought that it was going to have a nice breakout, and it did. If I go and look at, the Vega and, all that stuff, if it was a couple pennies here, a couple pennies there, or points, whichever Greek you're talking about, I'm still going to take that trade. I'm not buying options as part of a large constructed portfolio that are going out months where the Greeks would come more into play. For me, I'm starting with the charts. I'm looking for the breakout, and I'm going to look for, whatever option is going to, provide that liquidity, have that volume, and be aligned with my different price targets based upon the charts. Implied volatility is probably the main thing that I use, just because it's helped me so many times where, I've gone and looked and I've been like, why is this implied volatility so high? And you go and look, and sure enough, they've got a company announcement or investor day the next day. And it's created, not, I don't want to say red flags, but it's put up a flag basically of, some sort of warning of, Brandon, there's a catalyst here. There's something you need to pay attention to. And then you go and drill down, and sometimes you either like to trade even more or you take it off your list. So implied volatility is the main thing that I really look at there.
Okay. Somebody's just asking your advice, CRM. They're considering some covered calls on CRM. They're long from 158. And they're just looking at perhaps writing something around the 235 or 240. Not quite sure, Steve, with the questions you have here. Brandon. But do you have any thoughts on if you were to do a covered call on CRM? What would be your strategy?
Um, yeah, I guess that one's maybe a little hard for me since I'm like,
You're on the other side. I'm just saying, if you're
yeah,
playing devil's advocate, I guess.
yeah. I just figured I should put that asterisk there where, for me as a chart watcher, I see a big triangle that's loaded up there, and I am seeing a really nice break of it today. Good volume, clean candle. So with that said, I just wanted to say my 2 cents there.
Would that maybe, if you were to do it, suggest doing something a little further out of the money for
That's
a
exactly
possible
what I was going
breakout?
to say.
Yeah.
So what I would probably try to do there is, you've got some people loading in the calls today. I mean, so far today, you've got about 4 times the normal call volume. No surprises there. So in order to take advantage of that, I would probably, yeah, I would go further out of the money. I mean, you're not going to collect as much premium if you do that, but for me, I'd probably wouldn't look at anything less than the 210 from a quick glance. Yeah, because at this point too, in theory, this is a pretty nice break so far today, but in theory, this would probably have some sort of digestion day. It's kind of bumping up against the top of its upper Bollinger Band there. And if things really if the gas really gets going on the market in this, it's definitely got some more immediate upside, but I probably wouldn't look at anything below the 210 level.
All right. So I think we're just running up on just about an hour, so I think that's going to do it for this week's session. And we're going to be doing this on a weekly basis with Brandon. I think next week we might address SPY and the Qs options trade in there. And ask people for ideas on what they'd like to hear, so feel free to write in stuff. Now, we'll continue to develop this, but hey, Brandon, it's great having you on audio. Great having you on the trader product too. I really like the stuff that you're putting out there. So we'll continue to keep in touch with you. Obviously, you're always more than welcome on audio anytime you have something that you feel you need to say. And looking forward to continuing this chat with you over the next few weeks.
All right. Thanks, Gavin. I appreciate you having me on today.
No problem. Take care.
You too.
All right, we're going to shut down audio here and start everything back up in a little bit and get back to the market price action.